So this video is gonna be for me to kind of go over what I've been learning and kind of been picking up in technical analysis and reading trends. So trends are very, very important, and that kind of gives you the overall, I guess you could call it, battle between the bulls and the bears, right? So the bulls want the stock price to go up, and the bears want the stock price to go down. And no matter if you are a bull or a bear, you consider yourself a bull or a bear, when someone sells a stock, whether they were long in the beginning or they're opening a new short position, it is a bearish move. And therefore, as a seller of a stock, you are by that point a bear, and the price and the volume attributed with the transaction gives us verification of how many or of how much bears and bulls there are, were, whatever. And many technical analysis people, investors, mutual funds, hedge funds, traders, whatever, ETFs, they look at price levels as kind of their gauge, because that's all we know, right? We just know price. And all of those things, price, EMAs, exponential moving average, simple moving average, stochastics, relative strength index, all of those things play off of price. And then, of course, the next most valuable data source is volume, which tells us how many people are going plus and minus. And if you start reading the ticker, the tape, that is, you can kind of see how many people are buying and selling at certain prices. So that's why the trend is so important, because the trend will tell you how many buyers there are versus how many sellers, and then at what price are the buying and selling happening at. Therefore, establishing a fair current price. In the game of stocks trading, each time period, when you look at candles and technical analysis, if you look at candles or those funny bar looking things, each candle represents a period in time. And as those time periods get longer, like a 2-minute, 15-minute, 1 hour, 4 hour, 12 hour, daily, weekly, monthly, you can kind of establish a trend. And for people who are long-term investors, they might look at the weekly or monthly chart and say, I'm gonna buy on a lower high, meaning that the monthly trend is still going up, but I want to buy when the trend is still preserved, but we end that month, or that month is a lower high. So I'm buying in cheaper, but I'm still working with the upward momentum. I'm just kind of catching a longer term updrift. And maybe I'm gonna put my stop at the year time or the current year low. And if it drops below the current year low, I'm out of this stock. It's not where I want it to be. And that's kind of what we would consider a long-term technical analyst, right? Looking at it like, nah. For short-term technical analysis, you're looking at you're watching the 2-minute, looking for a 15-minute lower high, and you're coming in on maybe a oversold bounce or a stair step up, right? You're looking at, right, stair stepping up. I'm gonna get the 15-minute lower high on this 15-minute candle because the last candle closed here. I think I'm gonna get a lower high based on whatever it is, and then you can just reverse that entire thing for if you're bearish, right? So I think that's the mentality that you take. You look for the trend, you choose longer time frames, and you base your entry point on the longer time frames, lower highs. You know, like I said, if you're watching the 2-minute, you scout a 15-minute lower high. You see the lower high, you make your entry on the 2-minute chart, and you catch the uptrend, and you stop out at maybe the 15-minute lower, or if you break that 15-minute resistance level and you're out, or a 2-minute resistance level and you're out, depending on how aggressive you are. As the initial first example of the monthlies, you would use the annual stop out, right? Like the low of the year, that's when you would stop out. For a quicker trade, you look at the low of the day, or maybe the low of the current resistance level, or the bounce point, right? Depending on the time frames. So, and those are like the major things that you would look for when you're trading a stock in a vacuum, because many stocks are correlated with other things, right? For example, sometimes, like in the past, Facebook, this week anyway, Facebook has been a lead bull. So Facebook has been leading the market being QQQ, right? The NASDAQ. Market's been strong, Facebook has been stronger. Market has been weak, Facebook has been weaker. So you kind of look at these correlations, and when they start to unravel themselves, then there's something wrong, right? Something has happened where the normal correlation between a stock and the indice has changed. What do you do? What does it mean? Maybe we pull back. Maybe we don't know what's going on, so we exit the position. We scratch the position, come out with a small loss or small win, because now our technical analysis, our assumption when we went into the trade is no longer valid. Right? And then you can look at all kinds of things, market internals, you can look at, a lot of different things. Like the relative strength index gives us more of conviction to get into a trade. The RSI is at low levels on multiple time frames. It's oversold a lot. You have a trend level to play off of. You have price points to play off of. Then you make the trade. So there's a lot of these things that play into making a trade, but the primary and base things that you need to do to make the trade is going to be, obviously, price levels, right? Because other than that, you don't really know. So I think for trading technical analysis and getting this kind of system going, you really got to be able to look at the charts, look at different time frames, in your head kind of figure out, okay, this is what the 2-minute looks like. We probably got a lot of 15-minute candles that look like XYZ, a lot of 5 minutes that look like this, the daily looks like this, the weekly looks like this, because now we can kind of pull back and see, okay, we got a lot of investors who are worried about these time frames, right? Because longer term investors are looking at longer term time frames. So if we break key support levels and key resistance levels, then maybe there's going to be more buyers or sellers, right? There's going to have more volume, and those could create opportunity. And are we able to capitalize on those opportunities? Do we come in on an oversold bounce? Or is it just more confirmation on another leg lower going into consolidation? Or are we reaching an equilibrium where we have equal buyers and sellers and the price remains relatively sturdy for a time being? Or is it a falling wedge where we're having, bears attack a price level, but the bulls defending it really well, and we reach a point of climax where now, boom, all of a sudden the price of the stock goes through the roof because, we've had way more than enough of bear consolidation. The bears get tired, the bulls can go ahead and push it all the way up. Or are the bulls tired now, and we have a flip where it's a falling wedge or a rising wedge, and the bears keep defending a level, and then the bulls get tired, and then the bears take over and they push the price lower. So a lot of these things have to kind of play out through a longer period of time And a lot of different things play into it. There's a lot of different indicators that can help you make decisions, but it's not guaranteed. So that's kind of what I'm thinking. Anyway, it's just a video for me to kind of gather my thoughts before I, continue to chart away. And I'll see you guys in the next one. Bye-bye.